if you've got a self-managed fund with 2 individuals as trustees of the fund, and one of those trustees dies, then you either have to appoint a company as trustee of the fund, because you can't have one person as trustee of their own self-managed fund. You've got to have more than one, or you can appoint. So you can appoint a company, or you can appoint an individual, another perhaps a relative, as trustee. What does it require? Well, all the investments of the fund have to be changed then from the original deceased trustee into the new trustee. Probably a time where no one's really thinking about this sort of stuff. So having a corporate trustee as the trustee of your super fund can solve some of those issues, because none of the investments have to be changed. It's a fairly simple, straightforward lodgement of some company documents to change the directors of the trustee to company to be a new director, and life goes on. One of the key benefits that a corporate trustee gives you is a little bit of protection. And this is probably best illustrated by Charles' case, which would be humorous if it wasn't so sad. Mr. and Mrs. Sharp had a self-managed superannuation fund, and they were trustees in their individual capacity. It was a pretty substantial fund, and neither of them were 55, so they weren't eligible to be taking money out of their fund. Mr. Shale, unbeknownst to Mrs. Shale, took $3.46 million out of the fund and took off back to his home country. When the tax office finally found out about this a few years later, they made the fund non-compliant and levied tax. They levied tax of $1.58 million because the fund was non-compliant. They also levied penalties and fines of another $1.4 million. Huge amounts of money. But there's no money in the fund to pay these fines or taxes. So if there's no money in the fund, the trustee then becomes responsible for the payment of those taxes and those fines. Mrs. Shale was the only trustee left in the country. She became personally liable for over $3 million worth of fines and taxes. She contested that and lost. And she lost the house. If there had been a corporate trustee in place, there may have been a case for her not being personally liable for those fines, because the company was the trustee, not her individually. There are a lot of other facts around that case that make it even more murky, but the issue really is around trying protection of your personal assets. If I took the Tax Act and the Superannuation Acts and put them all on top of each one another, I probably wouldn't even be able to get onto the stool that it'd give me. There is that many rules and regulations about what you must do with your fund. I've picked out a couple of the key ones. Separate assets. Your self-managed super fund has to keep its assets separate from other assets. Consider a situation where you have a corporate trustee that is trustee of your family trust. It's also the operating company for your business, and it's also trustee of your super fund. How do you distinguish which asset belongs in which bucket? It's almost impossible. So the registration of your investments becomes very, very important, and we would normally suggest that you set up a separate corporate trustee for your self-managed fund, so it's clearly the assets of the fund are the fund assets and not anyone else's. Some documentation actually has to be held for 10 years, believe it or not. The tax office is kind of allowing us perhaps only 5 years for some of our personal tax information that we have to keep. But when it comes to self-managed funds, things like trustees' minutes have to be retained for at least 10 years. One could argue documentation around capital gains tax needs to be kept forever. And of course there's your annual requirements. You have to have a set of accounts done with your self-managed fund. Those accounts have to be audited. Those accounts have to include member statements. And you have to have a tax return done. There are due dates for super fund tax returns. So if you're slow in getting the information to your tax agent, then they're not going to be able to get the information into the tax office in time for you. So keep in mind, if for those who haven't yet stepped off and set up their own fund, 28th of February is when you've got to put the money in, lodge your tax return. The other big one, and this is an area which has seen some recent changes, is your fund's got to have an investment strategy. And all your investments have to be in line with that investment strategy. It's actually one of the things the auditors look at. They look to see that the investment strategy is current, and they look to see that the assets of the fund comply with the investment strategy. These days, since August, your investment strategy now has to take into account whether one or more members of the fund needs to have insurance. That's a new requirement. Other things it needs to keep, the strategy has to be in writing, by the way. And it also needs to take into account the risks associated with the investments that are being invested in. It needs to take into account the objectives of the self-managed fund and the cash flow requirements. And thinking back to that limited recourse borrowing arrangement, the investment strategy also has to have regard to the liquidity of your fund. You've got one big asset being a business premises. It's not very liquid, and so you have to have strategies around how you're going to deal with that with your fund in terms of paying out death benefits, for example. And the other new requirement for your fund is that the investment strategy must be reviewed regularly. What's regularly, you may ask? The guidance that came out with the regulations did say at least annually. So I suspect for those who aren't getting advice with their self-managed funds, that's probably going to be annually. Hopefully for those funds that are actively advised, you'll be hoping that it's being reviewed a little more often than annually. There's some new rules that apply from 1st of July this year, and I've picked out the ones that are important to trustees. There's some that are important to auditors and whatnot. We're not going to worry about those. Valuations of assets. From 1st of July this year, all of these rules I'm about to talk about apply from the 1st of July this year. Your assets will have to be valued at market value for the purposes of your financial accounts for your super fund. So if you've got a property in your fund, you're going to have to value it at market value. What's market value? Well, and how do you determine it? It's that market value has to be able to be supported by objective data. So it can't be what you want it to be. You've got to be able to support that. A letter from an agent might be appropriate. It doesn't have to be a sworn valuation. Off-market transfers, you will have heard us probably bleat about these a little bit in our blogs and our newsletters. And from the 1st of July, you will not be able to transfer listed securities between members and your self-managed super fund via off-market transfers. It'll have to go through an exchange. Now, to avoid selling and buying, because if you've got an asset, some shares in your super fund, and you want to transfer them out to your own name, to avoid selling them in the super fund, paying the cash out and then rebuying the shares, you can do what's called a crossing. There's all these new words that I'm learning as the rules change, but a crossing is done by a broker, and it's where two related parties are transacting together with that parcel of shares. It's done live on the market, so the market sees the crossing, and it's done at the market price at the time that transfer is done. So it's a completely visible transaction on the market. Of course, there's going to be costs involved with that because you're using a broker. So there are a few extra little interesting bits of compliance that have to be worked through with the markets in terms of facilitating that yet. We still haven't seen the final outcomes of that, but the legislation's there. We won't be able to do off-market transfers from the 1st of July. So if you are going to be transferring shares to your self-managed fund, for example, personally owned shares to your self-managed fund, and you want to do it by off-market transfers, you want to do it before 30 June.
Don't you have to pay capital gains tax?
Yes. Yeah. So
that's
correct. That's correct. Yeah. So if you've got shares that you own that have got huge unrealised gains, you need to be aware that transferring those shares to your super fund crystallises those gains. It's effectively selling them. Of course, the tax office got its wish. It can levy much better penalties compared to what it used to be able to do. It can, the key thing there is that the penalties can be pretty big now. They've got wider scope to ask for trustees to rectify certain situations, and they can even disqualify trustees if they want to. So it's they're fairly broad powers now. In terms of the quantum of penalties, well, they can range up to jail terms for really severe breaches. So the message is out there now for self-managed super fund trustees that if you're absolutely hell-bent on doing the wrong thing and you get caught, you will have the book thrown at you. There's no question about it. Probably been waiting for me to talk about this, haven't you? And there's a pretty good reason why I've left it till last, because these are only proposed. It was only effectively a media release from the Treasurer. So there's no legislation in place. But the key one, of course, that everyone wants to know about is this tax on earnings more than $100,000. What does that mean? From the scant information we have, the way this will supposedly be administered is it's based on an individual's superannuation benefit. So it's not based on a fund, it's based on an individual. And if their share of the earning, and they're in pension phase, so their superannuation is paying them a pension. So under the current rules, that means their super fund doesn't pay tax on its investment earnings. That great situation. Probably one could think too good to be true. If the earnings under these proposed rules is more than $100,000, the excess will be taxed at 15%. Now, that's where the $2 million figure got bandied around, because if you had $2 million if I had $2 million in my superannuation fund and it earned 5% earnings, then that would be $100,000. So anything above 5% or anything above $2 million, I'd start having some tax payable on my investment earnings. Now, we did a bit of an exercise and looked at one of the larger funds that we look after, and the average rate of tax was very, very, very low. It was less than, can you remember the percentage? It was on a fund of something over $6,000, it was about $30,000 between the two members. So it was a very small amount of tax that was going to be payable if this came in at its current price. The big issue, of course, is capital gains tax. If you've got lumpy assets in your superannuation fund that have been accumulating gains for tens of years, for decades, and you then sell your asset when you're in pension phase, thinking, beauty, I don't have to pay tax, and this rule comes in, you may find that year your earnings are well over $100,000. There are some concessions around the treatment of capital gains, but in the end, we don't know how that's going to be implemented. And look, the key issue with these is that, this is just some of the other ones, the key issue with these is that these are proposals only, and we've got to remember, we've got a budget in 2 weeks. From the budget, there's about 12 sitting days of Parliament before the winter recess, and then when the Parliament comes back to sit again after the winter recess, They'll effectively be in caretaker mode if the election's going to be on the September the 14th. So if you think about the amount of legislation that's going to have to be written, put out for consultation, then drafted again, redrafted and put into Parliament for debate, it's fairly unlikely we're going to see anything on these rules before an election. So it then becomes part of an election platform. So perhaps think about that, and I, personally, I'm not losing a lot of sleep over whether we have to be changing superannuation funds to comply with these types of arrangements. Can I be there? Self-managed super funds offer you a lot of benefits, and but getting it wrong can be painful and expensive. Now, I've covered a heap of ground tonight, and I've only touched on things, and I'm sure there's a lot of material that you would love to ask some questions on or want some more information on. And if I can't answer that tonight, certainly write it down on your feedback forms so that we can perhaps present on that next time. I've talked a lot about some of the, I suppose, must-nots and what happens if you do the wrong thing, and beware of self-managed super funds, but can't lose sight of just how good self-managed superannuation funds are helping you provide for your retirement. They're one of the most flexible ways you can accumulate assets and hold assets to fund your retirement income needs. You're in control of your cash flow. You're in control of your investment strategy. Your estate planning can be tailored to meet your particular circumstances. And the flexibility is there for you to change your arrangements as you wish. And it's for these reasons, it's not the tax, it's not the reason, tax isn't the reason you do things, but the self-managed super fund as a structure provides you an immense amount of flexibility to look after yourselves in retirement. Which I suppose, in the end, that's what it's all about, isn't it? That's why we're here, and we're trying to accumulate wealth so that we can provide for ourselves and our families. So that brings to a close the formal part of what I wanted to talk to you about. But I'd love to hear if you've got any comments, questions around self-managed superannuation funds and your roles as trustees of those funds.